Hey there, welcome to Fund to Money. From April 1, 2023, there's going to be significant change in the way taxation happens for debt funds. As far as your debt fund investments are concerned, if you hold units for more than 3 years, in the past, these were treated as the capital gains on them were treated as long-term capital gains. And you paid long-term capital gains tax on them, and you enjoyed two important benefits. One was you got inflation indexation benefits, which is basically it raised the cost of buying the units in proportion to inflation, put it very simply, and then you paid a 20% long-term capital gains tax. Now this was far lower than the 30% you paid, 30% tax you pay for being in the highest tax slab. So it was a benefit. Now from April 1, 2023, that benefit doesn't exist anymore. So what in effect is happening is, in the past, if you held debt fund units for less than 3 years and you made capital gains on them, they were treated as short-term capital gains, and you paid short-term capital gains tax, which is equal to the taxation happened according to your income tax rate. So basically, what's the change that has happened is, as far as debt fund investments are concerned, regardless of how long you hold the units, you're going to pay tax on capital gains, which will be similar in line with your relevant income tax rate. So this is a major change, and here we're going to tell you why you should not be bothered too much about it. That we'll be discussing those details a little more in the second half. But here, we'll just to give you a backgrounder, debt funds, their role is not deliver high returns to you. That's the job of equity funds, growth investment. Debt funds are supposed to discharge other very important functions, and they team up with your growth investment. So while no doubt, undoubtedly, higher taxes are going to make an impact on returns, but tax is not the reason why you should be making an investment. Tax benefits, it should be linked to your goals, your requirements, what is your risk appetite and stuff like that, how far your goals are. So that is important. And of course, as I just mentioned, debt funds have a different role, and they need to play that role. And when they play that role along with your growth investment, typically in equity and equity oriented investments, then you get the results that you want. Now the changes in tax laws as far as debt funds are concerned make no difference to the role debt funds are meant to play, right? Of course, they'll make a difference in the returns, but high returns is not what you should be looking at when you're looking at debt funds, because higher the returns, more the risk you'll have to take. And debt funds is supposed to discharge a whole set of different functions which are very different from the kind of functions equity and equity oriented investments give. So we'll talk about them in detail in the next section. Don't go away. The recent changes in the taxation of debt funds, basically the changes in tax treatment of long-term debt fund investments, which is till March 31st, 2023. That was about investment in debt fund units which are 3 years or more old. Now these changes, why they are not so significant, and you should not be bothering too much about them. So we'll start giving you the details and give you the arguments. Now let's look at existing investments that were made till March 31st, 2023. Now they will continue to enjoy the benefits, long-term investments in debt funds. So basically, if you had units which were held for 3 years or more, and you had invested till March 31, 2023, what happens is you continue to enjoy the inflation indexation benefit, which raises the cost of buying the units in proportion to inflation, and 20% concessional long-term capital gains tax. So those benefits you continue to enjoy. So that is that. So your previous investments are not getting affected. What happens as far as fresh investments are concerned from 1st April 2023? Now, as we mentioned, when you're looking at debt funds, it's not the returns, but there are other important roles which debt funds play. They become very important. Yes, of course, if you're holding long-term debt funds, returns become important. But look at the other important roles. There are far important roles which debt funds play, and they remain unchanged by these changes in taxation laws. So let's look at some of these functions which debt funds are supposed to play. Number one is easy access during emergency. So if you invest in liquid funds and short-term debt funds, and basically you save a certain amount of money through systematic investment plans for, say, medical emergencies, basically expense related emergencies. It could be medical emergency or any other emergency, or income replacement emergency like a job loss, or you're doing a higher education course. Now this is where debt funds, shorter term debt funds, liquid funds and short term debt funds, they are of great help. So that's number one. Number two is debt funds play a very important role in stabilizing volatility in your portfolio, investment portfolio. So you might be investing a lot in equities directly or indirectly through equity oriented or equity funds. So with the market going up and down, your returns will are liable or vulnerable to fluctuations on a yearly basis. Now if you want to save a large amount, you need consistent and high returns. Now how can you ensure that? You need a voltage stabilizer in the form of debt fund investment. So they work like a stabilizer because they're lower risk and of course lower returns, but what they do is they make sure that every year and year on year your returns don't fluctuate wildly. They remain on a reasonably high plane and you end up saving a neat pile, right? So the third role which debt funds play, and they have the potential, is securing your gains. So your goal is is around the corner, your child's higher education is around the corner, or your home buying is around the corner, and you're invested in higher risk investments like equity or equities or equity funds. You start in a systematic way bringing the money or the gains out there from your high risk investments to low risk ones, and you do it through systematic transfer plans, basically into debt funds. So what it does, it secures the gains. So that is the third role which it plays. Then of course you have periodic income or regular income. Now in case of mutual funds, you have systematic withdrawal plans. A certain amount comes to you regularly through the liquidation of units, or in lower risk investment debt funds, you can look at dividends if you will, but that periodic income requirement is that role can be played. Then of course periodic lump sum, you might need a lump sum every 2 or 3 years, and you make regular investment in closed-ended debt funds, for instance, say fixed maturity plans. If you're investing in them regularly, you get these regular lump sums. So these are some of the roles which debt funds play, and they have these roles. They're going undiminished. They're unaffected by the tax law changes. They have nothing to do with taxes. They'll continue to play this role for you, and this is what an average investor should be looking at. Now what about retirement income? Would you be looking at long-term debt funds if you're looking at retirement income? It will not be your first, second, third or fourth port of call if you ask us. Look at senior citizen savings scheme, 30 lakhs maximum limit. For a couple it would be 60 lakhs, 8.2% per annum now the current interest rate. Then you have floating rate Government of India bonds. There's no upper limit on invested amount. It's all set to deliver 8.1% or so annual interest rate, why would you be looking at a higher risk, uncertain source like a long-term debt fund for regular income? So what role can long-term debt funds play? Sure, they can play a role, and these are important roles, but what role can they play? So the role is going to be for a person or people with very large size portfolios. So if you're a high net worth individual, you have invested in lots of equities to balance the fluctuation, to stabilize the fluctuation, you need lots of investments in debt funds. Of course, it'll be nowhere near the growth investments, but what's going to happen is if you're going to invest a lot in in short-term debt funds, your overall returns are going to suffer. So maybe a little bit of exposure on long-term debt funds will not hurt at all. So it has to be, this portfolio size has to be large enough for you to look at long-term debt funds. Remember, they are high risk investments, so the high returns are coming because of the high risk. The usual risks that are related with debt investments, inflation, interest rates, reinvestment, inflation, all those are at play out there, and they tend to be a little far more sensitive to some of these changes, some of the market movements. So that is something that one has to keep in mind. So it's only for such people long-term debt funds would be of great use. And so what in effect, in conclusion, one can articulate that the recent changes in taxation of long-term debt fund investments, now that distinction is not there. That removal of that distinction is not going to make any difference to your approach as far as debt funds are concerned. We hope you found this useful, and the latest development will not be a bother for you, and it will not bother you. And if you've liked this presentation, hit the like button and share it with others. Till the next time, take very good care of yourself, and goodbye.